Hi, my name is Jonathan, and in this video, I'm going to be talking about limited company mortgages and why they are so popular with today's property investors. I'm going to split the video into 7 parts. What is a limited company mortgage? How they compare to personal buy-to-lets, who and how you can apply for one, directorships and shareholdings, independent legal advice and personal guarantees, what they can't be used for, and finally, why are they so popular with property investors today in this market? A lot to cover. Let's get cracking. So what is a limited company mortgage? Simply put, it's a buy-to-let mortgage, which is on a property, and that property is owned in a limited company structure. That's it. It's no more complicated than that. So how do limited company mortgages compare to personal buy-to-lets? I'm going to split this section into 3 parts for you. So 1, interest rates, 2, the availability of lenders, and 3, lending limits. So let's start with the first one, interest rates. So typically, you would expect to see personal buy-to-lets around 1% lower than limited company rates. But don't let that fool you. A lot of new property investors who enter the space think it's cheaper for them from an interest rate perspective to buy in their personal name. Now, that is completely true, but it's not the whole story. We've got to look at it from the angle of, well, what is the tax liability due based upon your income band and the 2 ownership structures, so personal versus limited company. Now, if you speak to an accountant, most accountants will say if you're a high rate taxpayer and you don't need the residual income, buy through a limited company structure. If you're a lower rate taxpayer, then don't buy through the structure because there's no tax benefit. Buy in your personal name, and obviously the money's in your bank account, and then you can spend it accordingly as long as you've got sufficient funds to pay the tax bill at the end of the day. 2, lending limits. So it is true, on the limited company side, if you are a higher rate or additional rate taxpayer, you can borrow more money, which makes it very, very attractive for those type of clients. If you are a lower rate taxpayer, then the borrowing limits are pretty much exactly the same. 3, the availability of lenders. So on the limited company side, because we're dealing with a very specialist marketplace, there are less lenders in that space than there are in the personal buy-to-let space. However, I've seen over the last 4 years of specializing in limited company mortgage transactions, the space is growing. And what's very interesting to see is that a lot of the big high street lenders like HSBC and Barclays, to name 2, just 2, are entering into this space. They're either buying specialist lenders so they can get a foothold in the limited company space, or they're funding lenders like HSBC did with Quantum. So who and how can you apply for a limited company mortgage? So let's break it into 2 groups. Group 1, you don't own a property, and group 2, you do, either your main residence or a buy-to-let which sits in the background. So with group 1, you are going to be considered a first-time landlord, first-time buyer. This will restrict you to around 10 to 15% of the marketplace, but certainly over the last 18 months or so, I've seen that space grow. So the number of lenders getting into the first-time buyer, first-time landlord space is growing. So you definitely have options there. The level of scrutiny on your application will be twice that of someone who owns a property though. Please keep that in mind. With those who own a property, you'll have access to 100% of limited company lenders. Now, there are some caveats with both. Okay, so the lenders are looking for clean credit profiles, decent incomes, that the story makes sense. So why are you looking to purchase in the area that you're looking to purchase in? And you're not over indebted. Personal guarantees and independent legal advice. Let's start with personal guarantees. So that essentially is a document issued by the lender that you need to sign on the basis that you are guaranteeing repayment of the debt which is held in your limited company. Now, typically, all directors will need to sign a personal guarantee, and depending on the lender and depending on the number of shares that the shareholder has, they may also be required to sign a personal guarantee. Essentially, it works exactly the same way as a residential mortgage if you have one. So on your residential mortgage, you've signed the terms and conditions of the loan, which pretty much means that you are liable for that debt in the event of repossession. It's exactly the same thing with a limited company, but because the limited company owns the debt, you have to personally guarantee it. And the only way for the lender to make sure that the debt is guaranteed is for you to sign a personal guarantee. Independent legal advice. So the 2 are linked. So independent legal advice is you sitting down with a solicitor and they talk you through the personal guarantee to make sure that you fully understood it. You obviously sign that document. That goes back to the lender to say, yes, you've had independent legal advice, you understand the ramifications for the personal guarantee, and you've signed it. Directorships and shareholdings. So this is a really in-depth topic, which I'm going to do another video about, which I will do a deep dive in. But today, I'm just going to keep things simple. So if you want access to 100% of limited company lenders, do not exceed 2 shareholders and 2 directors. So the directors essentially are the shareholders. Now, if you have more than 2 shareholders or more than 2 directors, that's fine. It basically just means that the Mortgage Works, which is the buy-to-let lending arm of Nationwide, will have to take it out of the mix. You'll still get access to 99% of the marketplace. Is it a good thing having TMW available for you? Well, yes, because typically they have the cheapest rate. But I appreciate with most clients, they do have more than 4 shareholders because of succession planning, inheritance planning, those sorts of things. And it's fine. There are plenty of other lenders that are pricing better than TMW or very close to them. Now, for most lenders, they will allow up to 4 directors. Some lenders will allow you to have an unlimited number of shareholders, but be very mindful with that, because it doesn't really work in reality based upon my experience submitting hundreds of applications to lenders over the last 4 to 5 years. So keep it simple. If you want access to the most number of lenders, which makes sense because we're always chasing the cheapest money, have 4 directors and have up to 5, 6, 7 shareholders should be absolutely fine. The simpler the structure, the more accessible these lenders will be for you to borrow money with. So what limited company mortgages can't be used for? So 2 things here. 1, they can't be used for you to buy a residential property for you and your family to live in. That's not what they're designed for. Think of a limited company mortgage as a buy-to-let, which is on a property which is housed or owned in a limited company structure. The purpose of the product is for you to buy an investment property and for you to let it privately, either on a short-term basis, on a corporate basis, to private tenants, or to family members, because you can do that. There are 3 to 4 lenders at the time of shooting this video that will actually allow you to let the property in a limited company structure to family members. The second point I want to make is that limited company lending cannot be used for properties which are uninhabitable. So they must be used for properties that are in a rentable condition. Now, there are certain products out there called refurb products that we use quite heavily at SPV Mortgages that will allow someone to purchase the property and then carry out a level of work. So this is a light refurb over a 3-month period. But these products are not wide and not varied. They're quite narrow in scope, and it's all to do with the surveyor's comments. In other words, if the surveyor goes out, visits the property and says, hey, the amount of work is this much, and we've obviously expecting it to be this much, then the lender's not going to lend. You'll need different lending for that, which is short-term or bridging finance, which, if you're looking at my videos, there is another one on that which goes into a bit of a deep dive. So check that out if you're looking to do something a bit more complex. So why are limited company mortgages so popular right now? So in other words, why are property investors buying more property through limited companies than they are in their personal name? Quite simply, let me take you back 2018 and the introduction of Section 24, which pretty much abolished mortgage interest tax relief. If you own a property today in your personal name, you can offset only 20% of the mortgage interest, whereas through the company structure, you can offset 100%. Plus, in your personal name, you're then going to be taxed. So 80% of the rental income is going to be taxed based upon your income tax band. So 20%, 40%, 45%. Through the company structure, you can deduct 100% of the mortgage interest, and then you're taxed at corporation rates, which is 19%. So that is the #1 driver why our clients and property investors out there are buying through limited company structures. So the second main reason why property investors are buying through limited companies is succession planning and inheritance tax planning. So think of it this way. You own 100% of the business which has bought the company. So the company's already paid stamp duty, land tax on that purchase. As you own 100%, of the shares, you can redistribute those shares to loved ones at a certain point in time in the future. Now, quick pro tip on this. The terms and conditions of the loan that you have in place with the lender that helps you buy the property in the first place, those terms and conditions are based on the structure of the company at the time of applying. If you are to change the structure of the limited company, my advice is speak to the lender. They are becoming a lot more lenient than they were, say, 2-3 years ago. Explain to them what you're looking to do, get their permission up front. A lot of these lenders are carrying out post-completion checks. If the shareholding or directorships have changed post-completion, you'll be in breach of the terms and conditions of the loan. You'll get a nasty letter in the post asking you to pay back the money or revert back to the original ownership structure. So keep that in mind. So the third reason is directors' loans. Now think of it this way. If you buy a property in your personal name, you put down 25% deposit, that 25% is then lost. It's converted from cash to equity. Whereas in a limited company, you loan the 25% to the company. The company then converts that 25% into equity, i.e. 25% is passed to the seller. You obviously buy the property, 25% deposit. Now, the beauty with directors' loans is that you can repay yourself a director's loan with residual profits from the company at any point in the future. And based on how HMRC view it, which is the monies that were put into the company have already been taxed, the monies coming out of the company, therefore, shouldn't be taxed. So there's no double taxing. So that is probably the third reason why property investors are buying through limited companies, because they can repay themselves their deposit funds at some point in the future from the residual profits that the property is generating. So let's do a quick summary. We've covered what is a limited company mortgage, what's the difference between limited company mortgages and personal buy-to-lets, who and how you can apply for one, directorships and shareholdings, independent legal advice and personal guarantees, what they can't be used for, and why they are so popular in today's climate. Now, if you've enjoyed the video, thank you very much for watching. Please give me a thumbs up, subscribe. It's a brand new channel, so your support will be greatly appreciated. And I will see you in the next video.